The current United States tax code allows some of the most profitable companies in the world to not pay any federal corporate income taxes.
The present tax system ain't fair.
Actually, at least 55 of the largest corporations in America paid no federal corporate income taxes on their 2020 profits.
And paid zero in federal taxes.
Some of these companies include big names like FedEx, Nike, HP, and Salesforce. These companies are not doing anything illegal, and these companies pay many other forms of taxes.
If a large, very profitable company isn't paying the federal income tax, then we have a real fairness problem on our hands.
And it's costing the government billions.
You can think about a bucket of corporate tax breaks that are deliberately there in the tax code. And overall, they cost the federal government roughly $180 billion each year. And for comparison, the corporate tax brings in about $370 billion of revenue a year.
Those 55 corporations would have paid a collective total of $8.5 billion. Instead, they actually received $3.5 billion in tax rebates.
Corporations can receive refunds just like individuals do.
And that doesn't include corporations that paid only some of these taxes, but not all.
The federal government estimates that there's about $40 billion each year in corporate taxes that are clearly owed.
Here's how the most profitable companies in the country avoid federal corporate income taxes. It's important to note the federal income tax is not the only tax corporations pay. They're subject to state and local taxes too. Right now, we're only talking about the corporate federal income tax rate, both domestic and international.
Federal tax rate at the moment is 21% for domestic profits, but it's as low as between 0 and 10.5% if those profits are profits of a US multinational that are earned offshore.
What do we do to make America the most competitive place in the world?
The 2017 Tax Cuts and Jobs Act slashed the 35% corporate tax rate to that 21%.
It's the only tax levied at any level that publicly traded businesses are supposed to pay in proportion to how well they're doing. Where the bigger you are, the more successful you are, the more you ought to be paying.
The corporate federal income tax, it's about 7% of all revenues that the federal government collects.
Let's look at Amazon as an example.
Alexa, how much tax should Amazon pay?
Sorry, I don't know that one.
Amazon became famous in 2018 when the company reported about $11 billion in U.S. income and paid zero federal income tax. They actually got a tax rebate of $129 million according to their financial reports. We now have 4 years of data. In those 4 years, Amazon has now reported $79 billion almost of U.S. income and has paid a total of $4 billion in federal income tax for a 4-year tax rate of 5.1%. So what that means is that they're avoiding income tax at the federal level.
Remember that the federal rate is 21%. So in 4 years, Amazon's effective tax rate was 5.1%.
I'll emphasize that everything I've just said about what Amazon is doing appears to be completely legal.
Amazon told CNBC that its U.S. taxes reflect its investments, employee compensation, and current tax laws. The company paid federal income taxes, other federal taxes, and state and local taxes. Publicly traded corporations have 2 different ways of accounting. So one form of accounting is for shareholders. Let's call it book income.
You have profits that are reported to shareholders using general accepted accounting principles under financial accounting. And the purpose of that is really to determine, is this corporation profitable? Is it worth investing from a shareholder perspective? How is the firm doing from a performance side of things?
And the second form of accounting is for taxes. Let's call it taxable income.
You have a set of rules that are different from and often diverge from that accounting. Determine how much tax a corporation is paying. And what that means is the amount of profits that corporations may be reporting for financial purposes may be very different from the profits that they are reporting and they're paying taxes on for tax purposes.
This is how some companies are able to tell investors we made billions of dollars, but turn around and tell the government we made $0. We can call all of these tools a form of tax expenditures. Tax expenditures are any targeted tax break. Think tax credits or incentives.
We want more oil. We want more solar energy. We want more manufacturing. We want higher paying jobs. We want more capital investment. And for each of these things, Congress has enacted a tax break that, at least on its face, is designed to encourage these things.
Take a tax credit for research and development as an example.
There's the R&D tax credit, which allows companies to take deductions and credits for their spending on research, the things they spend money on to, make better hamburgers in the case of McDonald's.
Tool number 2, accelerated depreciation, another form of tax expenditure. We can also call these write-offs or expensing. This is a key example of how those two different forms of accounting, book and taxable incomes, come into play.
If you are a corporation that's really in manufacturing, really capital intensive, you may make a really large investment in a given year. Under financial accounting rules to determine your profits you're reporting to shareholders, you may have to deduct that over, say, 10 years, for example, under the general accepted accounting principles. For tax purposes, especially, you may be able to accelerate those deductions in the given year, and in some cases, even taking a full and immediate deduction against your taxable income for that investment. What that means is you may be reporting a profit for financial accounting purposes, reporting no profit or even a loss for tax purposes. And that creates a difference between your financial income and your tax income.
Tool number 3, stock options.
There are tax breaks for stock options, which allow companies to write off the cost, with air quotes around it, of the stock options they give their executives and other senior employees.
So that just comes down to the different rules between book accounting and tax accounting for when that compensation can be deducted. For book accounting, it's deducted immediately. For tax purposes, it may be at a later date when it's ultimately vested to the employee, and that creates a discrepancy in the total amount of taxable income that these firms are reporting.
They write them off as if they were actual cash expense, when of course giving stock options to your employees is absolutely not the same sort of out-of-pocket expense that signing a check every 2 weeks is.
And finally, perhaps the murkiest of all tools, tool number 4, offshoring.
There is a very deliberate, at the moment, lower rate for foreign profits of US multinationals, and something between 0 to 10.5 on their foreign profits. And that's an outright tax benefit for them that's worth roughly $60 billion a year, according to the Joint Committee on Taxation. But it also creates this incentive to shift their worldwide profits into that sort of foreign low tax bucket.
US-based corporations are finding ways to shift income into tax havens. They talk about the Cayman Islands, about Bermuda, Bahamas, Ireland, and Luxembourg, and the Netherlands to some extent.
There are estimates that sort of shifting is in the tens of billions of dollars a year, up to $100 billion a year.
Here's an example. Whirlpool, a U.S. company known for manufacturing home appliances both in the U.S. and Mexico.
Whirlpool tried to avoid both US and Mexican taxes on the profits from its Mexican operations. And it did that by having the Mexican operation owned by a Mexican company with no employees, and then having that Mexican company owned by a Luxembourg holding company that had one employee. And then it tried to claim that due to the combination of the US, Mexico, and Luxembourg tax rules, the millions of dollars of its profits from the Mexican operations wouldn't be subject to tax in Luxembourg, wouldn't be subject to tax in Mexico, and wouldn't be subject to tax in the US. So it was trying to sort of take advantage of the disconnect between all of those tax systems to avoid tax in all of those countries. And a court said, no, that goes too far. That's not what the law actually allows.
Whirlpool told CNBC that it follows all tax laws in the jurisdictions in which it operates, and that Whirlpool's use of the tax code actually increased the amount of tax that the U.S. collected on its Mexican profits. The IRS thought Whirlpool should have paid those U.S. taxes earlier.
It's still quite possible for U.S. companies to shift their intangible assets out of the U.S. to avoid taxes. And it should be a top priority of policymakers right now to prevent them from doing so.
Accounting and tax experts say that probably the first best way to fix the problem is to go to the tax rules and look at each of the different provisions and decide whether or not you want that in the tax code, repeal those inefficient tax breaks or reduce them. Some say that is unrealistic, otherwise it would have happened anyway, and it's a hard thing to do.
One solution could be to beef up the IRS.
There is nothing the IRS does that is more cost intensive, that requires more resources than investigating the tax avoiding behavior of large multinationals.
Between 2011 and 2019, the IRS's budget for enforcement was cut by about a third.
One policy solution would be to implement minimum corporate taxes, both an international minimum tax and a domestic minimum tax.
That global minimum tax would end the race to the bottom in corporate taxation.
The legislation that's been debated by Congress would raise the U.S. minimum tax rate on foreign profits from 10.5% to 15%. Implementing an international minimum tax would help tamp down on some of the offshoring of profits that companies can maneuver about.
Where that country doesn't impose at least a 15% rate of tax, then the US will impose an additional tax so that the corporation pays at least 15% in each country. And that would raise about $350 billion over 10 years.
Then there's domestic profits.
One major proposal that's come out over the last year and advocated by both Biden administration and members of Congress has been to levy a minimum tax on book income directly.
Implementing a domestic corporate minimum tax of 15% could reduce the gap between the book income and taxable income, basically cutting down the value of some tax expenditures.
The first priority with corporate tax reform should be to get it to lift its own weight, to pay for companies to pay by whatever means something closer to the statutory rate, and the book income tax would certainly accomplish that. I think there are better ways of doing it. I think there are more all-inclusive ways of doing a minimum tax, but it's certainly better than nothing.